Hello, financial fans. We're going to talk a little bit about Dogs of the Dow. Dogs of the Dow is a strategy used by some investors to take advantage of the possibility that maybe one of the Dow 30 stocks has been beaten down too far during the year. And on the last trading day of the year, the investor buys the Dog of the Dow. The Dog of the Dow is the stock in the Dow 30 that has the highest dividend. The Dogs of the Dow would be two or more stocks in the Dow 30 that have the highest dividend, could be up to maybe 10 stocks. But basically, the investor is assuming that maybe this company, which is a very good company because it's on the Dow 30, therefore it is a very fine company, maybe it's been beaten down to the point where the dividend yield has gone up. They're still paying the same amount of money in their dividend. You receive that dividend payment, but it will be a greater percentage of the price once the price has been beaten down on the stock. So with that in mind, we'll take a look at the stocks. And by the way, you then hold the stock for a year, and you sell it maybe after a year and a week goes by, so that you get capital gains tax advantage for holding the stock for a year. But we will begin by looking at the stock, which today, this is not the last trading day of the year, this is 12/16, so there's still a couple weeks left for trading. But if today were the last day of the year, this would be the dividend yield and so on these Dogs of the Dow. And we're going to begin with the stock that is known as Chevron, and CVX is the symbol. And we see on this particular time that we clicked on the price, it's $88.73 is the price per share. And we look down the middle of the first column, 52-week range, $51.60 to $122. So it's in the middle there. It has a lot of headroom at $88.73. So far, that looks good. Then we go down to the volume. Average volume is 11 million, so that's good. Then under that we see overvalued. The experts seem to think that Chevron's going to be going down even further. And yet, if we look at the bottom of the middle column, it says that the one-year target is 101.38. So that might be one to hold on to. The dividend yield is very good, 5.77%, so that's nice. The question would be how great a future Chevron and any oil company has, and it might have a good future, and who knows, it might not. That is a stock that could jump up in a big way in 2021. But the reverse is also true. It could fall back depending on what happens with oil stocks in the future. Look at the next stock now, Dow Incorporated, which has a symbol DOW. $53.82 is the price on that stock. Look down at the 52-week range, halfway down the first column, $22 up to about $58. So it's getting near the top, but it still has some headroom there. The dividend in the middle of the second column, dividend yield 5.28%. That's a very good dividend yield. You could just hold on to that as long as they pay out that $2.80. Whatever happens to the price, you'd be making a good percentage on your investment. The PE ratio not available because they lost money. Earnings per share down $3.17 a share. 1 year estimated target down near the bottom of the second column, $51.83. So that doesn't look good. And in the lower left hand corner, Yahoo, it says it's overvalued. So I would stay away from that stock. International Business Machines, IBM, is our third stock that we're looking at. $125.89, $125.89. 52-week range, $90 to $158, $91 to $159. And that means it's got some headroom, IBM, and it has a good PE ratio, 14.27, not as good as I would like, but it's still good for a stock that's in the dogs of the Dow. And the dividend yield 5.18, so it is a good one as far as dividend yield. They're expecting the stock to go up to 137 this year, but they do say that it's overvalued. That would be one I would consider investing in, but I think I can find a better investment out there. The next stock we're going to look at, since we looked at some of the dogs of the Dow, we're going to look at a cat of the Dow, Caterpillar. Caterpillar has a symbol CAT, cat, and the price per share at the time I took this snapshot, $179.93, $180 a share. And the 52-week range, $87.50 to $183, so it doesn't have a lot of headroom left. And the dividend is small, but at least it's a dividend, 2.27%. The PE ratio is higher than I would like, but that's not too outrageous. It's just that I would prefer something better. I think I could find something better. So I'm avoiding the cats and the dogs of the Dow. But here's a stock I'll recommend, Intel, $51.31. I do own this stock, by the way. The symbol is INTC, and the 52-week range saw it going from $43.61, $43.61 to $69.20. Or is it 29 I guess, 43 to 70. So 51, it's got plenty of headroom, and the PE ratio 10.04. I like that. Forward dividend yield is 2.61, and their expectation is it will go to a one-year target of $52, which is not much of a move at all, but they do say it's undervalued. I think it's going to go quite a bit higher than the $52. So anyway, that's the cats and dogs of the Dow, and Intel added as a little extra suggestion. And remember, don't buy any stock until you've studied the market for at least a year, and I thank you very much for watching.